Mutual funds have various investment strategies at their disposal. Diversified funds, for example, invest in a broad spectrum of stocks and sectors. Then there are sectoral funds which actually target a very specific sector. And then there are thematic funds. So thematic funds actually focus on a particular theme. And therefore they invest in stocks or sectors which can be varied, but they all fall under the umbrella of that theme.
Sumera, it's important to understand the difference between sector funds and thematic funds. Sector funds are actually more specific. Information technology is one specific sector. Pharmaceutical is another specific sector. FMCG, IT, these are all sector funds. When it comes to thematic funds, they are a broader universe of stocks which can be bought. For example, rural consumption, where you have different stocks like FMCG stocks. They also have consumption from cement to different other sectors combined into one. You can also look at infrastructure as a theme. Road laying companies could form a part of infrastructure, cement manufacturing, steel manufacturing. So the universe which the fund manager has to invest in infrastructure is far broader. So this is important to understand because their risks are distinctly different. And for you to choose a sector and a thematic fund, you will have to be far more careful and understand the nuances of the stocks in the underlying sector or the theme which have come together to form a mutual fund.
What's the profile of investor who should be looking at thematic funds? And even in that, what should be the allocation?
I think a person who invests in a thematic or even a sectorial fund for that matter has to have a larger risk appetite. He or she needs to have the capacity to absorb and live with the volatility these bring into the portfolio. To put some numbers in perspective, thematic funds are almost 50% more riskier than the normal diversified large cap funds. So, as the number suggests, I need to be more riskier or somebody who has the appetite to take that risk is when I would get into that. And even if you so do, I don't think you should have more than 20% of your money in thematic funds because it's important to remember that the fund manager is also buying those stocks in the rest of the funds in the form of diversified funds. So, you can't double do the same thing by adding significantly more portions in thematic. So 20% would be that number, I would say.
Okay, and historically, have thematic funds surprised on the upside?
Yes, actually they have, because if a theme catches momentum, everybody's speaking about it. All fund managers are skewing their existing diversified portfolios. So in 2008, infrastructure was the theme, and that's what actually ended up happening. Sector funds and thematic funds formed a part of people's portfolio, and the fund managers also skewed 30-40% of their existing portfolios there. So half of people's portfolios was in infrastructure before the crisis happened.
Okay, so what you're saying essentially is that existing mutual funds, whether they are diversified, large cap, mid cap, already are skewed to the theme of the day, and therefore you should invest in a theme only if you're utterly convinced about it.
Correct. And because there is going to be double doing of the same allocation, so you'll have to look at it from a portfolio standpoint. So a cap, which we just mentioned, is a very relevant number.
Okay, so thematic funds are clearly for those who are convinced of the theme. But what's the size of the industry? I mean, what's the universe that investors have to choose from?
The current size of the thematic and sector fund all put together is 73 funds with almost about 44,000 crores of AUM, which is sizable.
But that's also because they're easier to market, right? So for everybody who's looking to invest in thematic funds, you have to note that unlike, say, diversified funds or any other large or mid-cap fund where you can remain invested for, say, as long as you like, here the theme will eventually max out, so you have to know when to exit.
ELSS is a mutual fund which invests its money in equity, locks in the money for 3 years, and you get a tax benefit under the Section 80C.
So it's like hitting two birds with one stone. You have capital appreciation and, of course, you save on tax.